Of course, in the private equity world, we focus less on the value of stocks day to day than we do on longer term type of occurrences. So we are not as subject to the day-to-day vagaries of the market, though we do own publicly traded stocks once we take them public. But generally, I would say the markets are going to vacillate for quite some time. Look what happened today. The Federal Reserve Chairman made a speech, a very good speech, but the market went down in response to that. I think you're going to see that for a long time, and I just think it's going to take a while before people are comfortable that the bottom has been hit.
I mean, to that point, David, your co-CEOs at earnings had to withdraw outlook going forward. I mean, how long do you think the private equity industry or Carlyle more specifically will be in a position where you're only earning that 2% management fee and you're not realizing the 20% performance fee? Is it next year you're back to being in profit in that sense, or 5 years away?
No, nobody can say for certain. I don't think it's 5 years away. Remember, in the last great recession we had about 10 years ago, private equity performed extremely well and outperformed public market averages consistently, and I suspect that will happen again. Today, what private equity people are doing is making certain that their employees are healthy, the companies that they own are having employees who are healthy, taking care of the healthy employees, number one. Number two, making certain that the values of the companies are preserved and, when necessary, enhanced by additional equity or buying debt back or things like that, or putting in additional debt. And three, looking for new opportunities that might arise because prices are low. There's a variety of things we're doing. Private equity is in pretty good shape, relatively speaking, but we're not magicians. We can't do things that are magical. We have to deal with the economy that we live with. But generally, I think we're in pretty good shape relative to everything else.
About those opportunities, David, and that dry powder that you have, I mean, are you seeing a lot of them out there right now? And if so, where? Well,
as a general rule of thumb, people that are sellers tend to think that their prices shouldn't go down as much as buyers think they should go down. And so when you're ready to buy something now in this environment, you're probably going to have to wait a while, because I think sellers haven't yet adjusted to the likely decline of the value of what they own. So we have a fair amount of dry powder, as do the other large private equity firms. We see a lot of opportunities, but we don't think that if you don't move in a week or two or three or a month, that you're going to miss the best opportunities. Some of the best opportunities that occurred in the last recession occurred, 3, 4, 5, 6 months into the recession when people made investments. So we are not basically upset that we're not putting out a lot of money right now, because we have a fair amount of due diligence to do. We see a lot of good opportunities, and we're waiting for the right opportunities to come along.
Given that dry powder, as you mentioned, David, do you think it's fair that private equity-owned companies should not have access to government bailout, government support programs?
The most important thing is employees, that they have jobs and they can feed their families and they're healthy. So whether you are employed by a private equity firm or a public company or a family should not be that relevant. But I recognize the political situation on Capitol Hill and elsewhere. But I think Congress should worry about employees and making certain that they're okay, and not whether the private equity firms own them or not. But in the end, that's a difficult argument to make in this environment. But I'm more worried about our employees and the employees of smaller companies than I am about whether private equity benefits.
When you think about, David, some of the opportunities, and you mentioned the timing is key and you don't have to necessarily pounce, how are you thinking about short-term versus long-term changes as a result of this pandemic in all sorts of industries, from travel to technology? I mean, where do you think the best opportunities are, given, things are going to change as a result of all of this?
Well, Sir John Templeton famously said that the biggest mistaking words in the investment world are "this time is different." But I think he was wrong in this case, because this is just not a recession. It's a gigantic healthcare problem. And I think people's lives are going to be changed, and the way they deal with their lives in the future will be changed, just as the way people lived through the Great Depression changed their lives. So my parents lived through the Great Depression. They were scarred by it. People are going to be scarred by this, and therefore I think people won't travel quite as much as they did before for a while. They won't go to as many hotels as they did before for a while. They won't eat out for as much as they did for a while. They won't go to as many big sporting events for a while. But it will change eventually. It may take a year or two for people to come back to these habits, particularly if we get a vaccine. If a vaccine comes forward, then I think all bets are off, and I think people will go back to their conduct. And based on the conversations I've had with people at NIH and other places, I do think there will be a vaccine in the not too distant future. It takes a while to test them, and you have to produce them. But I don't think with all the people working on it that it's unlikely we won't get a vaccine. I think we will get a vaccine, hopefully before a second wave of this comes along.
David, Carlyle's due to acquire a stake in American Express Global Business Travel and has pulled out of that, saying the pandemic qualified as, quote, a material adverse event. Are you concerned that there's any reputational damage by doing that to Carlyle, that you've stepped away for a deal that you'd signed on the dotted line for?
I can't comment on that, as all the lawyers and everybody else have told me, and I'm a lawyer, and so I know that's good advice. I can say this, that in situations like this, firms that have been around for a long time that have a very good reputation will find their reputation will stay intact. We've been in business for over 30 years. We have a very good global reputation. People know we're people of integrity. So I don't think our reputation is going to be harmed by one deal or another deal or things like that. But other than that, I can't comment on that specific situation.
Well, David, I mean, I'm not a lawyer. You are a lawyer, so I'm up against a Goliath in this sense. But the material adverse event clause that's always in every deal that companies like yours do, is that not really designed for a company-specific thing that emerges in your target company that you're acquiring, not a broad global macro event that applies to absolutely everyone? What if you were about to buy Zoom, for example, or one of the stocks that's massively benefited from this pandemic? Would they be able to say to you, in fact, we deserve double the price, we're walking away at this price? I don't think they would they?
Well, first, I'm not a Goliath in the legal world, because if I was, I'd be practicing law, so I wasn't that good a lawyer. So you're probably not at a disadvantage in talking to me. But I would say that it depends on what the specific language says in many of these kind of contracts. And material adverse clause provisions vary. Some of them have had pandemic things. Some of them have not had pandemic things related to them. It just depends on what the language says. I don't really have I'm not going to comment on that specific situation. But I think these clauses are well designed generally, and people who execute these contracts generally are familiar with the provisions. So I just can't comment on what is in a specific provision in a particular deal, though.
Maybe a broader deal question. We know Uber's trying to buy Grubhub. Do you see this as a unique example just because of what we're dealing with in terms of M&A activity, or do you see deal making picking up here as a result of the pain and businesses that are shrinking and suffering, and in many ways the bigger ones being able to be resilient and to do these kind of deals? Right.
I do think you'll see strategics doing a fair bit of buying, which is what this is. The Uber deal really is a strategic kind of acquisition. And I do think some companies that are hard pressed for business now or cash may want to do deals. And we see plenty of these opportunities as well. The timing of these things, though, may vary. But I do think you'll see a fair amount of activity, as you did in the last, in the Great Recession we had about 10 years ago. A lot of acquisitions occurred then, too. And I think you'll see a fair bit of it now. And I think the M&A lawyers and the M&A bankers are pretty busy these days.